Hi everyone. Today we're diving into an important topic for business owners, buyout planning. Now I know this might not sound like the most exciting thing on your to-do list, but trust me, it's critical if you want to avoid chaos when a business partner passes away, retires, or otherwise exits the business. Today we'll be talking about two key strategies to help you avoid financial headaches down the line: the Insurance LLC and the cross-purchase trust. Now, this might sound like just another day of business jargon, but there's a twist that makes the conversation even more relevant today. The Supreme Court's recent ruling in Connolly, which changed how insurance policy benefits are treated under a stock redemption plan. We'll get into why that ruling matters and how those two strategies, the Insurance LLC and cross-purchase trust, can help you steer clear of trouble. Let's kick things off with a brief refresher. The problem with stock redemption plans after Connolly. In case you missed it, the Supreme Court ruling in Connolly clarified how the value of life insurance proceeds should be treated in a stock redemption plan. Now, under such a plan, a business buys life insurance on its owners, and when one owner dies, the business uses the insurance proceeds to buy back the deceased owner's stock. Sounds simple, right? Well, here's where it gets tricky. The court ruled that the life insurance payout must be included in the value of the business. This means that if your business uses a stock redemption plan, those insurance proceeds are now part of the business's valuation, which can significantly inflate the estate tax the decedent's partner heirs will owe. The problem is that while the insurance helps buy out the deceased owner's stock, the increased business value could lead to an unexpected tax burden, something you probably weren't planning for. So, what's the solution? That's where the Insurance LLC and cross-purchase trust come into play. Now, these strategies avoid the issues created by the Connolly ruling because the insurance policy isn't owned by the business itself. The Insurance LLC, what this offers is centralized control, lower tax risk, and we're going to start by thinking this as a separate entity that's specifically set up to hold life insurance policies on each business owner's life. Now here's how it works. The LLC owns and is the beneficiary of the policies, and the owners for their estates are the insured. When a partner dies, the Insurance LLC collects the life insurance payout and uses those funds to buy out the deceased partner's share of the business, which is then distributed to the remaining partners. But here's the key. The business itself does not own the policy, so the proceeds from the insurance aren't included in the valuation of the business for estate tax purposes. Why does this solve the Connolly problem? Well, by separating the ownership of the life insurance from the business itself, the Insurance LLC sidesteps the problem laid out by the Connolly ruling. Since the insurance proceeds don't go directly to the business, they aren't included in the business's value, which keeps the deceased owner's estate from getting hit with a higher tax bill. The Insurance LLC also offers a few other benefits, which include centralized control. It consolidates all the insurance policies into one entity, which simplifies administration. It also has equal buyout power, which means all partners can equally contribute to funding the LLC, ensuring that no one partner is left trying to come up with more money to buy out the deceased partner's share. Now, what about the cross-purchase trust? Well, this offers a simplified buy-sell without the complexity. In this setup, each business owner buys life insurance on the other owners, and the policies are held in a trust rather than being directly owned by the individual owners or the business. When a partner passes away, the trust receives the insurance payout and uses those funds to buy the deceased partner's share of the business on behalf of the surviving owners. Here's the good news. Much like the Insurance LLC, the life insurance proceeds in a cross-purchase trust aren't included in the value of the business under the Connolly ruling. The trust structure ensures that the insurance proceeds are kept separate from the business, thus preventing the payout from artificially inflating the business's value. Now, how does it solve the Connolly problem? Well, because the trust holds the insurance policies and handles the buyout, the business doesn't receive the proceeds directly. This effectively avoids the estate tax problem created by that Connolly ruling. The trust simplifies the process, especially for businesses with multiple owners. by centralizing the insurance policies in one entity. Now, this makes it easier to manage and ensure the funds are available to buy out that deceased partner's share without the added burden of valuation inflation. Comparing the two, Insurance LLC versus the cross-purchase trust. Which one's better? Now, an Insurance LLC or the cross-purchase trust? It really depends on your business's size and structure. In this case, the Insurance LLC, it's a great option for larger businesses with multiple owners. It offers centralized control and flexibility, especially if the owner changes frequently or new partners are brought in. Plus, it keeps things streamlined by holding the policies in one place. The cross-purchase trust is typically easier to manage for smaller businesses with only a few owners. The trust owns the policies, so you avoid the complexity of setting up a separate LLC, and it simplifies the buyout process by having the trust handle everything. Both strategies, though, are excellent ways to avoid the issues raised by this Connolly ruling. They ensure that you're not inflating the business's value with insurance proceeds and avoid unexpected tax consequences for your partner's estates. So what's the takeaway here? Well, planning for the future of your business isn't just about making sure the lights stay on. It's about protecting your partners, their families, and your business from the financial pitfalls that could come from an untimely exit. Now, whether you choose an insurance trust or an LLC, both strategies offer smart ways to avoid the pitfalls of recent Connolly ruling, ensuring that you and your partners are prepared for the worst without overburdening the business or triggering unnecessary taxes. The good news, with a little bit of planning, you can keep your business safe and your partner's families financially secure without Uncle Sam taking more than his fair share. Thanks for tuning in today, and please share this with someone you know who maybe owns a business with a partner. Until next time, keep doing life better.